Hello, everybody, and welcome to my video solution walkthrough for problem 15-3. This is the intermediate accounting gold standard, the very best of the best, except for par value. 17th edition textbook. Authors are Don Kiso, Jerry Weingett, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. So the solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation, as well as bad dad jokes and everything else, are those of mine, Bennett Tchaikovsky, and not the authors of the textbook or of Wiley. Okay, so let's get the accounting party started. All right, so over here, I've got equity transactions and statement preparation. So Hatch, hopefully not the survivor Hatch, has two classes of capital stock outstanding, 8% $20 par preferred and $5 par common. This is, again, I'll just show this unless you're Berkshire Hathaway, Mr. Buffett's company. Yeah, we don't like pina coladas. No, excuse me, that's somebody else. Right over here, you got to have a par value very low, right? The other part of this too is that Hatch company is probably not publicly traded. When you are publicly traded, they're going to make you get rid of your preferred stock. As I've mentioned on previous videos, if you're going to have anything, it's going to be some sort of convertible debt. So Hatch has two classes of capital stock outstanding, 8% 20 par preferred and $5 par common. At December 31st, 2020, the following accounts were included in stockholders' equity. So let's just go ahead and have some fun here. So we've got preferred stock issued, preferred stock outstanding. This is going to be 150,000 shares. Okay, and then okay, so then the preferred stock par value is at 20. So my preferred stock at par $150,000 times 20, or the 3 million. So that's where that number is coming from. Okay, so we have common stock issued. Okay. Okay, so my common stock par value per share is at 5. My issued shares are 2 million. Outstanding shares are the same. Okay, and then right over here, so my common stock at par is going to be 5 times the 2 million, or the 10 million. And then we're going to have our, we'll also do this over here. We've got preferred stock APIC is 200,000. We've got over here common stock APIC is at 27 million. Okay, so we've got the common stock at par, the additional paid in capital common stock, that's all worked out. And then we're going to have retained earnings of 4.5 million. Okay. So as I look at this without, kind of saying, okay, so issued preferred shares, issued common shares at a 2-for-1 split, bought back treasury stock, resold treasury stock, preferred dividend is declared, and a common dividend is declared, and net income is 2.1 million. So we don't have to do the journal entries. Rather, what we'll just kind of do for this question is we'll just kind of mess around with the table. So I'm going to also add into this column, I'm going to add in treasury stock. Okay. And I'm also going to add in APIC or treasury stock, APIC. Okay. So, and just so we know what this means, TS does not mean totally sexy. That means treasury stock. I got that from GARP. PS does not mean, I don't know, pissed and shouting, preferred stock. CS is not CS darn, no, it's common stock. Okay. And APIC is not the way I like to pick my nose. Rather, this is additional paid in capital, or what I'm paying beyond the amount. Okay. So we've got all that sorted out. Let's go ahead and start it on some fun. So on January 1st, God, if it was January 6th, I don't know what I would do. 30,000 shares of preferred stock were issued at $22 per share. Okay, so 30,000. So I'm going to issue 30,000 of preferred stock. So this is going to increase by 30,000. My outstanding shares will also be increasing by the same amount. My par value per share is 20. So my preferred stock at par is going to be increasing over here by roughly, I shall just do it like this. We can keep it like this, 600,000. The difference, or the difference between the par value and what I'm selling it for, is going to be at $2 per share. So this is going to be 2 times 30,000, or $60,000. Okay. So for January 1st, if I were to do this as a journal entry, I'd be getting cash for 30,000 times 22. I would then credit preferred stock par, APIC, preferred stock. This would here would be at 600,000 and then 60,000, and this would be on 1/1. So that's how I would go through and record this. I'm doing the share adjustments just because that's something that I'm going to have to deal with later, because I'm being asked to prepare the stockholders equity section. Okay, so on 2/1, what I'm doing here is I'm issuing 50,000 shares at $20 per share. Okay, so my common stock at par is going to go over here to 250,000. Again, you never ever want to use a par value this high. It's April 20th times 30. So the difference over here is going to be 2 additional paid in capital. So this is going to be $15 per share times 50,000 shares, or 750,000. So if I were to go ahead and do this down here, 2/1, my cash is going to be 50,000 shares at 20, or $1 million. I'm going to be crediting common stock at par, crediting additional paid in capital common stock. My common stock at par is going to be 250. My additional paid in capital common stock is going to be at 750. I assign the 5 times the 50,000. And then over here, this is going to be 20 times 50,000, or my sales price. The rest of it goes over here. So this will be 22 times 30,000. This is going to be 20 times 30,000. The rest goes to additional paid in capital common stock. Okay. Now over here, I'm doing a 2-for-1 stock split. Par value is reduced to 250. Okay, so let's just go ahead and do this for our own sanity. So pre-split, I have preferred shares. That's not changing. My preferred stock at par, preferred stock, additional paid in capital. Okay, my issued shares are 2,050,000 Outstanding shares are 2,050,000. Pre-split, my price per share was still at 5. Over here, my additional paid in capital is 27,750, and I have no impact over here on retained earnings. So pre-split, this is what it looked like. If I do a 2-for-1 split, and this is on 6/1, 2-for-1. Okay, none of this is going to change. However, my common issued shares are going to increase by 2, or basically the 2-for-1. Okay, so this is 2,050,000 times 2. This is also going to be 2,050,000 times 2. My par value per share will decrease, right? So this is now going to be at 250. So my common stock at par isn't really going through and changing. It's still going to be the issued times the 250. And then my additional paid in capital is not changing, and my retained earnings is not changing. So when I do a share split, that's what it is going to look like. And we'll make this small. Okay, so that's my 6/1, 2-for-1. On 7/1, I repurchased 30,000 shares of treasury stock for $10 a share. Okay, so when I buy back my own shares, this is going to decrease my outstanding shares by 30,000. It's not going to impact my issued shares. It's only going to impact my outstanding shares. So I'm bringing back 30,000 of these into the treasury. Okay, so when I went through and I bought these 30,000 shares, I now am going to be having treasury stock at 30,000 times 10, or over here at 300,000, and this is going to show up as a negative amount. Please take the time to look at the Home Depot. This is probably the best example of treasury stock that's out there. When you show treasury stock, it's going to show as a debit balance, because when I do the journal entry for the treasury stock, right, 30,000 shares repurchased at 10s per share. So this over here is going to be 7/1. I'm going to debit treasury stock. I'm going to credit cash. Right over here. Okay, so I've got that over here. So this is, so again, I'm decreasing my outstanding shares, and my treasury stock is now going to be showing a negative amount over here, and this is going to be on 7/1. Okay, I'm now reissuing treasury stock at $11 per share. When I do this, when I sell the treasury stock at 11 per share, and this is going to be on 9/15. So this is going to be cash. This is going to be 10,000 times 11, or what I sold the stock for. And then over here, I'm going to credit treasury stock for what I paid for the shares. So this is going to be 10,000 times 10, or $100,000. The additional amount in excess of this is going to go to additional paid in capital treasury stock, or 10,000. Okay, so let's go ahead and put this into our formula. Notice here on 9/15, right over here, what's happening is that I'm going over here and saying my outstanding shares are now increasing by 10,000. Over here, my treasury stock is now no longer 300,000. Rather, this is going to be increasing, or I'm going to basically credit treasury stock. This has a negative balance because it's part of owner's equity. So this is going to increase that amount by 100,000. And I'm also going to have additional paid in capital treasury stock for 10,000. So again, this is going to increase my amount of outstanding shares, right? When I buy it, it decreases my outstanding shares. I leave the issued shares alone. Okay, on December 31st. Oh, this is going to be fun. So the preferred dividend is declared and a common dividend of 50 cents per share is declared. Okay, so this is 12/31. Now, let's do the common shares first. Okay, so let's go ahead and look at those common shares first. I'm just going to check something real fast. Okay, so when I declare the common dividend, right, what I'm going to be doing over here is I'm going to go ahead and say, all right, so I'm going to have dividends. I'm going to be crediting dividends payable. Okay, so in order for me to kind of figure this out, what I need to know is in terms of the total. And let's just go ahead and put in net income right over here. So net income is going to have the effect of increasing my retained earnings. My net income is 2.1 million. Okay. So let's take a look at the dividends, and we'll actually do 12/31 common stock, and then we'll do 12/31 preferred stock. Okay. So when I declare the dividend, right, this is going to be the same thing as basically reducing retained earnings. Right, our dividends get closed out to retain earnings. So what I need to know is that what are my total number of my shares that are outstanding for this basically prior to the dividend. So I take my shares post split of 4.1 million. I bought back 30,000 and then I reissued 10,000. So my total shares outstanding are 4,080,000. Notice that I'm not going to do the dividend based on my shares issued. Why? Because I own 20,000 of the shares. I'm not going to pay a dividend to myself. Even though I like myself, I'm not going to pay a dividend to myself. So my shares outstanding as of 12/31 are going to be $4,080,000. My dividend per share is 50 cents. So the total amount of my cash dividend that are the dividend that I'm going to be going through and declaring is going to be 2,040,000. So right over here, dividends payable is going to be 2,040,000. This is going to be a liability, right? So where does the common stock dividend go? This is going to show up over here as a negative amount because the dividend is going to be reducing retained earnings. So I'm going to show that as a negative to this retained earnings, like basically my tracker right over here. Okay, let's do the preferred stock. For the preferred stock, what this is telling me is I'm declaring a preferred dividend. So the preferred dividend is 8% $20 par value preferred. So what I'm going to do is I'm going to take for the preferred dividend. So I have 180,000 preferred shares. So my preferred stock outstanding is 180,000. My par value per preferred share is $20 per, basically is $20 per. So my total preferred stock value or total preferred stock at par is going to be 180,000 times 20 or 3.6 million. When I'm doing my preferred dividend, I'm going to base this on the value of the preferred stock at par or at 8%. I don't care about the additional paid in capital preferred stock. It's contractual right over here. So my preferred dividend is going to be at 8%. So my preferred dividend is going to be at $288,000. So right over here, I'm going to have preferred dividends. This is also going to hit retained earnings. And I'm going to have preferred dividends payable. And this is both going to be at 288. Okay. So right over here for my preferred stock, this is going to be showing up. That's my net income. So my preferred dividends are going to be reducing my retained earnings by 288,000. Remember, retained earnings has a credit balance, right? So when we're going through and doing this, we have debit, credit, assets are equal to my liabilities plus my owner's equity. Okay, so retained earnings is part of owner's equity. So when you see this, this has a credit balance. What happens is that when I pay a dividend, ultimately it's going to debit retained earnings, it's going to reduce it. So that's how I'm getting why I'm showing these as negative numbers. Doesn't matter if it was paid, it was declared, and that's when it's going to go through and hit. Okay, so when I look at this total, so when I look at this chart, so I've got preferred issued shares 180, outstanding. My par is still at 20. So my par value here is still the same amount. Additional paid in capital is still going to be at 260. My par value per share is now at 250. So my common stock at par, and again, I'm basing this off the issued shares. And then over here, I've got additional paid in capital on the common stock of 27,750,000. My treasury stock balance is going to be showing up as a negative 200,000. My additional paid in capital treasury stock is going to be at 10 million. It's going to be 10,000. My ending balance and retained earnings is going to be 4.5 less the common dividend, less the preferred dividend, plus the net income, or 4,272,000. Okay, so when I add up all of these amounts here, the preferred stock at par, additional paid in capital, preferred stock, the common stock at par, additional paid in capital, common stock, less the treasury stock, plus the additional paid in capital treasury stock, plus the retained earnings, I get 45,942,000. So let's now go ahead and put this into a statement. Okay, so when I'm doing the statement, so for Hatch, I'm being asked to prepare a stockholders equity section. So we're going to say here, Hatch company statement, or let's see here, balance sheet, partial, as of 12/31/21. And so right over here, what we're going to do is we're basically going to say, okay, stockholders equity. So I'm going to start this with preferred stock. Okay, so I'm going to basically say preferred stock, authorized shares, and then we're going to say 180,000 shares issued and outstanding. Okay, and this is a $20 par value. So this is going to be 3.6 million. Okay. The solution breaks up between par, between the two different items. So we can kind of say over here, we'll deal with the par ones first. Then we have common stock. You have authorized shares. And then you're going to have 4.1 million shares issued. So I've got common stock. They usually should show you the authorized shares right over here. Sorry, issued is 4.1 million. Issued, and then 4,080,000 outstanding. $2.50 par value. And this is going to be over here at 10,250,000. Okay, so total. You know what? This is not the way I would do it. Let's go here. So we're going to have additional paid-in capital preferred stock. Additional paid-in capital preferred stock. This is going to be 260,000. Additional paid-in capital common stock. This is going to be at 27,750,000. And then we're going to have over here, we can have additional paid-in capital, or we'll have treasury stock or additional paid-in capital, treasury stock at 10,000. Retained earnings. Retained earnings would be 4,272,000, and then we would say less treasury stock. So my total stockholders equity is going to be 45,942,000. Just give me one moment. So here you have a situation of a stockholder's equity. You've got preferred stock, and then you have like this, again, most publicly traded companies, when you're dealing with preferred shares, you're going to kind of see, this is an example from a company called iPower. What you're going to see is you'll have the, the preferred, the common, the additional paid-in capital, and the retained earnings. Typically, if it's publicly traded, then there's no way that the exchanges are going to want you to have any type of a secondary stock outstanding, because the disclosures relating to how that's going to be potentially be dilutive or impact the common shareholders becomes extremely complicated. And then let's see over here. So what I've done is that this is Snap Inc., which is the parent company of, basically for Snapchat. And what I'm doing is I'm just kind of wanted to show you a little bit to kind of see that, well, pre-going public, this is what Snap had. And so you can kind of see all of this stuff here, like in terms of the different convertible. But what you'll notice is that they essentially have a pro forma. And what does that mean? It basically means is once they go public, all of this is going to get basically wiped out, because when the company is going to be going through and actually doing its listing, it's just going to have 3 different voting common stock, or just 3 different share levels of common stock. And that's kind of similar to Meta or Facebook, which has Class A, Class B shares. So when you look at this, right, and again, this kind of tells you the mess of when you're getting through and doing different shares of stock if you're a privately held company. And you see this Series A, Series C, all this fun stuff. So that's really what we would be kind of going through and looking at. So again, in terms of going back to our question over here, is this necessarily the best way to go through and do it? Probably not. The textbook offers a solution where they group the par values up here. So they kind of say like capital stock, and then they'll show additional paid-in capital for preferred, common, and treasury. Then they're adding in retained earnings, and then you've got less the treasury stock. So again, this solution here is different than what you may see online. But again, this is really just to kind of give you a better idea in terms of how to go through and to disclose it. So in any event, I want to thank you and Wiley thank you again, Wiley, for allowing me to share these solutions with you. Please don't forget to like and subscribe. If you ever need other solutions, please feel free to ask for them in the comments. Have a great day, and I look forward to seeing you on the next video. Have a good day.